Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
All right, let me go ahead and fast forward a few slides. You know, as you can kind of hear from my conversation with you guys today, trading is a lot about discipline. It's about reading the patterns, but then also understanding how to trade the patterns. Not just, oh, there's a wave 4, I should short it. It goes beyond that. It's about reading and interpreting and understanding the patterns. Become a student of the markets. That's what makes a successful trader. Understand what these indicators are telling you. So enter at the cross of the regression trend channel. Your profits are at your mob objective. That's the type 1 trade. Now, from the other side of it, the Elliott type 2 trade. The Elliott type 2 trade is taken once a wave 5 is at a new low or a new high. It doesn't have to be historical highs or historical lows, just at a 5-wave pattern low. That's what you see here on the Canadian dollar coming into like the first week of September 7th of this year. This is a 2008 chart. Right here, we have a 5th wave identified by the program. There's 2 identification rules for a type 2 trade. You know one of them already. The market will come in and label it as a wave 5. That's where you see that happening. The second rule, or the second thing we look for on the chart, is an oscillator pattern. During wave 4, I had mentioned that the oscillator should pull back to 0. During a wave 5, after that oscillator pulls back to 0, kind of what we did here during the wave 4, the market will come down and make a new 5th wave low, which is what this euro did, or this Canadian dollar did. So if you take a look from where we sold off on August 24th, that was also a very nice type 1 trade. You could have shorted the Canadian dollar at 96 cents and taken profits at 92. That was a very nice type 1 sell. The wave 5 is in place at this point. Now we need to look for what pattern on the oscillator confirms that a wave 5 is present. What we look for is what we call oscillator divergence. We're going to compare the oscillator's look when it was in wave 3. So this was the wave 3 oscillator. Market was in a wave 3. There's the oscillator pattern that was on wave 3. Wave 5. Here's the oscillator pattern for wave 5. Now, Elliott termed wave 5 as new lows or new highs in a market with less strength. In this case, we're looking at weakness because the market's moving in a downtrend. What we want to see for that wave 5, we want to see the market make new lows, which it did. It made new lows. Take a look back just from your previous wave 3. There was your wave 3, and the market has made new lows. Step number 1. Has the market made a new low with less strength or less weakness? We'll compare the oscillators. This was a very weak market on the left. This market, even though we made new lows, was not quite as weak as the wave 3. This is oscillator divergence. And when you see that oscillator divergence pattern, that tells you that the end of a trend is near. If wave 5 made new lows without that oscillator divergence present, that tells you that the wave 5 will probably continue selling off. Okay? So that is your oscillator divergence that you're looking for. So we get the trade, we can get it off the dashboard, or if we're just monitoring certain currency charts, we can get it that way as well. We examine the trade for the type 2, wave 5 on the chart, oscillator divergence present. Now we trigger the trade. We also look for our time objective. This market should rally. We're looking for this market to have a change in trend. My projected target is September 29th at 96.50. So as of that chart, we were on September 7th. We've got about 3 weeks, September 29th, at a price of 96.50. That is our next projected area of resistance. We've got a pattern to work with. Now, all we need is a cross of a regression trend channel. Where is this trade going to trigger? Where is this down pattern going to end? How can we get into the market? Right here on September, right around the 12th, it breaks the regression trend channel, and I'll put a little square around that because I know the chart's a little compressed. Right about there is when we break the regression trend channel. After it breaks, we have a little period of sideways activity, even a little bit of a downswing there. It never took out the previous lows, but the market sustained, and on September 23rd, we hit our target. Now, we were originally calling for a target to be hit on September 29th. We hit it on September 23rd. A little bit early, but not too bad. It was a Monday instead of the previous Tuesday. And again, we're taking and looking at the next 4 to 5 weeks of market behavior and trying to get you a price within a few days of where you can look for your option strike prices. So it's not going to be always perfectly exact. It's going to give you a guideline of where, within a few days on most charts, where we're going to hit a specified price. That was the Canadian dollar. Here is the Swiss franc on a daily chart. Now, if you remember the type 1 I told you about on the Swiss franc, but somehow my slides got a little goofed up there. Here was the original type 1 trade that we had in the Swiss franc, and we talked about how it would make new lows at about 85 cents on October 17th or so. Well, it hit new lows on October 20th. So we were off a day or two, but again, that's a month-out projection back from September 15th. We still got it within a few days. The market has made a new low down here at wave 5. Take a look at your oscillator pattern. Here was wave 3. Here's your wave 5. That is perfect oscillator divergence. This market may have made a new low. That market may be ripe for a change in trend. So we go to the next step. Trigger and our projected price. Now, this trade has not yet fulfilled itself. Our next goal for the Swiss, if you're watching the Swiss franc, November 16th at 95 cents. This trade is still very much in progress, and it has not hit our target. Right now, this is a daily chart. It's October 30th. So we've got about 3 weeks for this market to hit its objective. November 16th at 95 cents. So that's a little bit more forward-looking. That's a trade that's currently in progress right now. But those are two of the more popular patterns that options traders use for advanced get. There are 5 trades in the arsenal. We've got an XTL trade that would take care of you in wave 3. Little higher risk. Not too much we can do as far as time and price projections, unfortunately. So options traders generally don't like to trade in the wave 3. Wave 4 and Wave 5, the patterns are a little bit more dependable. We have the mob objective for where our targets and price and time will be. Those are the trades that most option traders would like to use. So a summary of the Type 2 trade, our Wave 5, our oscillator divergence. Those are the 2 patterns that we want to see on the chart. We're going to enter, just like we did on the Type 1, at the cross of a regression trend channel. And we're going to be looking to take our profits at the mob. We're going to get into the trade due to a certain pattern. We're going to exit the trade when it hits a certain price and time point. We're going to take our profits, and we're going to move on to the next trade.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.